Traders are shorting it. China's moving $1 trillion out of it. And for the first time since 1973, the US dollar is collapsing during a president's first 100 days. Bloomberg says Asia's sitting on a $25 trillion bomb, and they're getting ready to pull the pin. The dollar index is crashing, bond auctions are failing, and nations are rewriting trade deals without a single U.S. signature. This isn't theory, it's happening. So ask yourself, if the world no longer needs the dollar, what happens to America? Asia's quiet financial realignment may already be triggering the most significant dollar liquidation since the collapse of Bretton Woods in 1971. Bloomberg reports that the U.S. dollar index is down nearly 9% since January 20th, the worst first 100-day performance under any president since Nixon unpegged the dollar from gold. Economist Stephen Yen, CEO of Eurozone SLJ Capital, estimates that up to $2.5 trillion in dollar-denominated holdings, mostly by Asian exporters and institutional investors, could begin shifting out of U.S. assets. These positions, largely unhedged naked longs, are dangerously exposed as trust in U.S. policy erodes. Jen warns that the scale of potential outflows could dwarf typical FX adjustments and potentially overwhelm dollar liquidity. But if Asia truly pulls the trigger, does the U.S. have any defenses left? The U.S. dollar's global reserve status, long described as an exorbitant privilege, is being strained by political volatility, inconsistent policy, and a breakdown in institutional credibility. Bai-Pan Rai of BMO Global Asset Management states that the dollar's dominance was built on predictable foreign policy. Strong institutions and low capital barriers conditions now in flux. Trump's renewed tariffs and his public threats to fire Fed Chair Jerome Powell, though later walked back, sparked fresh concerns about the independence of the Federal Reserve and the stability of U.S. economic governance. According to Deutsche Bank, these signals are already altering global asset allocations in ways that structurally disadvantage the dollar. If trust is the foundation of reserve currency status, how many more cracks can it take before the structure buckles? Over decades of trade imbalances, Asian economies accumulated vast dollar surpluses, now a potential vulnerability as political friction intensifies. According to data cited by Jen and Joanna Frew, roughly $2.5 trillion is now concentrated in dollar assets held by Asian exporters and sovereign funds. These aren't broadly diversified holdings. They're mostly exposed unhedged bets on dollar strength accumulated during years of consistent U.S. imports and stable returns. But that reliability is unraveling. With Trump's 2025 tariff reinstatements, disrupting supply chains, and souring bilateral ties, these surpluses are no longer viewed as safe stores of value, but as geopolitical liabilities. If even a portion of that capital rotates out, it won't trickle. It could cascade. So, who's bracing for impact? Stephen, Jen projects that China alone could repatriate up to $1 trillion in dollar holdings as declining U.S. interest rates reduce returns on treasuries and equities. As the Federal Reserve signals rate cuts to cushion recession risks, Chinese institutions already wary of sanctions and supply chain blacklisting are quietly reducing exposure to U.S. assets. According to Bloomberg's April data capital, flows into Chinese local bonds are rising, while demand for U.S. treasuries among Chinese buyers has hit a multi-year low. This isn't sudden decoupling. It's strategic repositioning. Chinese tech firms, for instance, have accelerated divestments from U.S. equity markets in the first quarter of 2025, reallocating funds into domestic research and development and yuan-denominated funds. The goal appears less about retaliation and more about insulation. But if China moves first, who follows next? Let's stop right here, because this isn't just capital flight. This is a controlled demolition, not a sell-off, a strategy. China isn't panicking. Asia isn't scrambling. They're executing. While Wall Street's still debating basis points, $2.5 trillion is already looking for the exit, and no one in Washington's holding the door. The question now isn't will the dollar fall? It's how fast before it's replaced. Since the start of 2025, the Taiwanese dollar is up 6.2%. The Chinese yuan has gained 4.9%, and the Malaysian ringgit has strengthened 3.7% against the US dollar, according to FX data compiled by Reuters through April 30th. This coincides with the greenback's worst early-term showing under a U.S. president in over 50 years. Analysts at UBS suggest this shift may not be organic. It may be tactical. By allowing regional currencies to appreciate, Asian policymakers can both absorb inflationary pressures and increase leverage in trade disputes with Washington. Stronger currencies also support domestic consumption, a growing policy priority in post-COVID recovery plans. The timing suggests these aren't passive market reactions, but calibrated responses to shifting global power dynamics. But if the next phase is active selling, what signal does that send to investors still holding the bag? Speculators are no longer hedging. They're exiting. According to CFTC data, hedge funds and asset managers held nearly $10 billion in short dollar positions as of April 15th, marking the most bearish net stance since October 2024. UBS cut its dollar forecast twice in under 2 months, citing a deteriorating macro outlook driven by stalled U.S.-China trade diplomacy and weakening institutional confidence. Bloomberg reports the dollar index has declined nearly 9% in Trump's first 100 days, worse than any modern presidency, prompting a structural repositioning by sovereign wealth funds and currency strategists. Deutsche Bank warned on May 6th that the dollar may enter a multi-year weakening cycle as global allocation trends shift toward more politically neutral assets. The question isn't whether sentiment has turned, but how far it runs before policy catches up. The collapse of a unified trade order is no longer theoretical, it's operational. In 2025, trade between China and Russia is already 96% settled in yuan or rubles. According to China's State Administration of Foreign Exchange, bypassing the dollar entirely, India and the UAE formalized non-dollar settlement channels in early Q1, while Indonesia and Malaysia expanded bilateral payment frameworks tied to local currencies. These regional compacts aren't just political optics. They're being supported by investment in digital payment infrastructure through platforms like Enbridge, jointly backed by China's PBOC and Hong Kong Monetary Authority. Bloomberg Intelligence noted in April that fragmentation in global trade is producing fragmentation in global currency, flows a trend that pressures dollar demand from the bottom up. If the dollar was once the highway of trade, alternative corridors are being paved fast, and they may soon bypass Washington altogether. A cheaper dollar might sound benign until it hits the checkout line in bond market. According to the Bureau of Labor Statistics, U.S. import prices jumped 1.8% in April 2025 alone, the steepest one-month increase since 2011, largely driven by currency depreciation and rising shipping costs. As foreign exporters, price and dollar weakness, consumer inflation risks becoming structurally embedded, particularly in energy, food, and tech sectors that rely on foreign inputs. Simultaneously, the Treasury market is flashing red. The 10-year yield spiked to 4.82% in May's bond auction, after foreign demand plunged to 58.9%, down from a 64.1% six-month average, forcing primary dealers to absorb the difference. A Fed caught between rising inflation and weakening demand may find itself paralyzed, unable to cut without worsening capital flight, unable to hike without deepening recession risk. In this bind, the dollar doesn't just fall. It drags stability with it. History says reserve currencies don't die overnight, but they do decay. The pound sterling's decline spanned 5 decades, eroded by war, decolonization, and currency crises. Today, the U.S. dollar's foundation, built on institutional trust, military influence, and trade dominance, is showing simultaneous fractures. Stephen Jen's $2.5 trillion figure isn't speculative. It reflects real movable capital currently concentrated in Asia's export-heavy economies. Baipan Rai notes the structural erosion of dollar credibility, echoed by Deutsche Bank's warning that euro-dollar parity could arrive faster than models suggest. Trump's second-term tariffs, Fed White House tension, and the political weaponization of finance all accelerate the divergence. If capital is leaving credibility weakening and alternatives rising, the narrative isn't collapse, it's recalibration. But once confidence exits a currency, does it ever return unchanged? The dollar isn't gone, but its immunity is. The systems that gave it global reach are being re-engineered in silence and software in Shanghai boardrooms and Abu Dhabi currency exchanges. Investors aren't waiting for headlines, they're moving on whispers. And as $2.5 trillion inches toward the exits, the world's financial map is being redrawn without a press conference, without permission. So ask yourself, if the foundation of the dollar was never military, might, or political power, but belief, what happens when belief fades? Because while the West debates what's next, the East may already be building it. Because the next global financial system is already under construction. And this time, the U.S. might just be locked out.